Nice job, nice job. Hey, real quick, also, a quick welcome. We have joining us today Sarah Archer. Sarah spent a lot of time in her employment career with Boy Scouts of America in a lot of different roles and overseeing, I don't know how you consider them, regions and different departments, fundraising, all kinds of things there. Got into the insurance business last year. Did some work site stuff, and so got a chance to meet her, gosh, over the summer, and things finally lined up to where she officially starts with us today. So, Sarah, glad to have you with us today. All right, so Leonard will be kicking us off. So the key thing, just a kind of set the stage for this. Western Southern Agency really is a section that allows us to have marketing agreements with other companies to sell their products. So they're not part of our core compensation, but they are part of compensation and everything else. So one of the companies, or one of the products that we have is this hybrid life insurance long-term care. The position of a product like this is generally going to help for someone who's looking older and they're thinking about concerns of long-term care, and how can you use that benefit dually, both in a long-term care situation as well as some life insurance benefit. The product is OneAmerica, is the company who underwrites and sells this. So we have access to this product. It's newer. This is a product that has been out in the industry a little while, but with concerns of long-term care, it's becoming more and more of a hot topic. So this product being made available to us now. So by all means, take notes. So if you think about it, through Western Southern Agency, the organization that distributes a lot of products, financial brokerage, and Leonard Berthelsen is kind of our field rep for us to get information and connect with him, and not just this product, but some other products within the Western Southern Agency portfolio as well. But I know many of you have talked to Leonard in the past, but if you have not, you'll want his contact information, and I think many of you have signed up for the WebEx. This is originally scheduled for the 7th. We had to cancel that one, and we moved it to today.
All right. Good morning.
Good morning. Can you hear us?
Yeah, I can. I'm going to go ahead and mute folks because I'm getting a little bit of a feedback here, and then we'll go ahead and get started. At the end, I'll open it up for questions, and we'll be able to answer them at that point. So let me go ahead and mute things. All right. Well, good morning. As Bill said, my name is Leonard Berthelsen. I handle all of the accounts with Western Southern when it comes to, first of all, this hybrid product, and we're going to go into a little bit of detail this morning on that. Also, all of your DI business that you would encounter. We've got 5 different carriers that we can offer when it comes to the DI side. So, but let's really focus this morning on this new asset care process with OneAmerica. It is known as a life long-term care combo or hybrid product. And before we get started, I'm just going to have a little bit of a shout out to Sarah. Welcome. You picked a good company to join. I've worked with Bill and many of the agents in the office there over the course of the last couple of years. So good decision on your part. So let's kick this off. Most folks, when it comes to long-term care, are concerned about the real big issue is, as we run into the case with a lot of folks, that they just simply feel that they're going to somehow outlive this issue about long-term care. Statistics tell us, and of course insurance is all about statistics, but and these are not necessarily things that I would drone on about when I'm talking with a client. But the reality of it is that about 70% of the people over the age of 65 are going to have a long-term care event happen at some time in their life before they die. That may be a short one. It may be a long one. It may be one that really involves a whole host of healthcare type of issues. So a lot of folks seem to think that they're somehow going to be able to avoid that. They're going to fall into that 30% category. But those that are truly concerned about long-term care and how to fund it and how to pay for it so that they're not spending their own dollars for it, the other big concern that they wind up with is traditional long-term care, which has been around now for about 35 years. It's a use it or lose it proposition. When the government got involved in long-term care here a couple of decades ago, they made the decision to have the benefits of long-term care be received by the end consumer or the client on a tax-free basis. And the trade-off with the industry is that the industry no longer would offer any kind of return of premium. That being the kind of the catalyst for traditional tax-qualified long-term care. Benefits are tax-free. The ability to be able to, cash the policy in and get some, retainable value back out of it just is not there with these tax-qualified plans. That became a real issue with a lot of people, and that is that they don't like the idea of buying something, not using it, and passing away. And basically, those dollars are just simply lost. The life long-term care hybrid really addresses that issue, and it takes that particular concern off of the table all the way around. They do that by the means of designing this and developing this on a life insurance chassis versus being designed and developed on a long-term care chassis. First and foremost, it is a life insurance product. It's a whole life product. So what that means is that it has cash value retention. It has the ability to access those dollars in the event that you decide that you no longer want it. It also has built-in, much different than traditional life insurance that has a long-term care rider. This is not a rider. This is actually built right into the product itself. And we're going to go into some detail as we go through this morning so that you get a little bit better understanding. Your clients have spent years dreaming of their retirement, traveling the world, spending time with their grandkids, enjoying new and old hobbies, whatever the case may be. We all kind of have that vision in our mind as our careers get into the golden years or the twilight years, as they say, and start looking at things that are going to be a little bit more important in our lives and be a whole lot different. The last thing that they need to happen is to have a catastrophic long-term care event that can just really, it can ravage, an estate, a financial plan, anything that you've done for your clients in the terms of other life insurance, retirement planning, stocks, bonds, securities, whatever the case may be. All of those are jeopardized as a result of a long-term care event. And a long-term care event in this world today, it's not a cheap endeavor. There's no doubt about it. The average nationally runs about $6,000 a month, and the average duration that a person would be on a long-term care claim is going to be roughly just a shade under 3 years. So that kind of gives you a little basic understanding of what kind of benefits should be designed and where should those benefits be in moving forward. If your client will need long-term care, OneAmerica solution can help them when that time comes. First of all, and this is probably one of the key factors in long-term care today, and that is controlling their care. The last thing they want to have happen is somebody else telling them how they're going to get that care, where they're going to get it, how often they're going to get it. They control that 100% on their with their policy. Now, the company as with OneAmerica, as it is with Mutual of Omaha, Genworth, John Hancock, any companies that have sold long-term care over the years, they all have what's known as a care coordinator. That's someone that is actually hired. It's not an employee of the insurance company. They're hired by the insurance company to be the advocate for the policyholder. First of all, ensuring that every benefit that the client is entitled to, they are accessing that. And number two, helping them understand what type of care they need for the prescription that the healthcare provider has drawn up, whether that be the nurse, whether that be the physician, whatever the case may be. They're making sure that all of those benefits are first being accessed, and then number two, that they're the right kind of benefits that are being accessed, the right kind of care. Uh, it not only protects their family and their loved ones, the big issue here is that it's protection for the family. It's protection from the family from the standpoint that they're not having to spend the majority of their own dollars to provide this kind of care and this kind of assistance for a loved one. They have the ability to tap into dollars outside of the family and outside of the family dynamics and the retirement and the assets that are there. It allows them to access care. It allows them to access benefits and have that paid for by an insurance product. Maintain their independence. Number one thing that consumers tell us when it comes to long-term care, what's the biggest thing that they fear? And that's losing their independence. What's the number one independence that a person loses that you will see a spiraling downward? And that's their ability to be mobile on their own. A lot of that involves just simply the ability to walk without the assistance of a cane, walker, wheelchair, whatever the case may be. Or it may be the fact that they're no longer safe in a driving situation. And, the car or the driver's license has to be taken away, by the adult children in order to maintain that person's, safety. That's the independence issue. They want to be able to remain independent as long as they possibly can. And where is this care typically going to be provided? If we go back 20 years ago, 25 years ago, the primary function for people in a long-term care setting was in a care facility. Assisted livings weren't even around at that time, but the vast majority of people that needed care, it didn't happen at home. It went, they went to a care facility, they went to a nursing home, they went to a skilled facility, whatever the case may be. The reality of it is today is that about 82% of all of the claims that the carriers are seeing today are for home care. It's for care that's provided outside of a nursing home, outside of assisted living, in the community. It might be adult daycare. It might be hospice in the final weeks and months of life. It may be just simply home health care, the assistance being brought to them on a daily basis, on a weekly basis, whatever the case may be. That allows them to maintain their independence. And then to capture all of that together into one, it's to preserve their assets, simply allowing them to use the assets that they've set aside for specific reasons to allow that to continue. Because when a long-term care event occurs and you don't have means set aside to take care of this, not many people I've run into in the course of my career have I seen them with $200,000 sitting in an account in a reserve just in case long-term care becomes an issue. They just simply don't do that. And even if they did, my concern would be, in talking with the client, why would you want to protect this concern with 100% dollars when you could do it for pennies on the dollar? And that's what long-term care and a hybrid combo type of product will do. It'll allow them for pennies on the dollar to give the kind of protection that they need so that they don't have to devote specific retirement dollars that were intended and were set aside for a different use. Now all of a sudden they have to scramble and use that. And going back to an earlier statement that I made about life insurance that you may have sold or securities, investments, whatever the case may be, what do you think the first thing's going to get tapped if a long-term care event occurs? It's going to be the easiest and most liquid of assets. So probably it's going to be the checking account, then it's going to be the savings account, and then they're going to start into the retirement accounts that they've set aside. And I'll tell you what, there is nothing that will devastate an estate or retirement plan quicker than a long-term care crisis. And that's what we really want to do. We want to avoid having that happen for our clients. So it's a triple win for your clients with this type of a product. Again, traditional long-term care doesn't have a death benefit on it unless you put that on the plan, and it's very expensive to do so with traditional long-term care. It doesn't have any kind of cash value growth built up in it, where a hybrid product does. And they have access to 100% of the death benefit for qualifying long-term care services. So if the base policy is $200,000 of life insurance, they have access to the full $200,000 of that death benefit prior to dying to be used for the purpose of long-term care. And we'll discuss in a little bit here how the formula works for that. will help your clients build a customized strategy that works for them, not trying to pigeonhole a product into their life. This is really designed around what their needs are, what their choices are, and then finally, what are their desires. And if you can get that done with your client, you've been successful. And that's what we really want you to kind of focus on, making sure that you're building this and you're customizing it based upon what their needs are. I've said this many, many times. I don't know too many people out there when it comes to long-term care or protecting assets with a long-term care product that build and design and customize a plan that's going to give 100% protection. People don't do that. It's too expensive, number one. They also look at it from the standpoint of need. They're just interested in the need for that. Most people recognize that if they can protect 70, maybe 75% of their risk factors of long-term care with some type of an insurance product, then they've done a pretty good job. And so we look at it from the standpoint, okay, let's design plans that make some sense. I'll get requests in for quotes all the time, and it's not a fault of an agent. It's just an agent not understanding how that process works. They want a $10,000 a month benefit for their client, and they want a 5-year plan with 5% compound inflation, and the client's 60 years old, and they're in absolute mortal shock when they get the quote, and the quote's for $15,000 a year in premium. Doesn't make any sense. Let's look at it from the standpoint of, first of all, what are we protecting? Second of all, what's the best way to protect it? And then thirdly, we want to customize it to where it's going to make some sense. So generally, when I send quotes back out on the OneAmerica product, I'll go ahead and build the quote exactly as it's being requested. And if it's out in left field someplace, I'm going to go ahead and send an alternate. And that alternate's going to be based upon the state in which you live in. What are the average cost of care? I'm going to design and build a second plan that makes a little bit more sense, that really gets it down to an affordable factor. That's the key thing. It's great to have all these, grandiose benefits in a plan, but if the client can't afford it, it doesn't make a lot of sense. All we've done is we've demonstrated that this insurance product is way overpriced, and it's really not. You have to customize this to make it work. Well, with this OneAmerica product, it can be done as a single or a joint plan. And I really like the joint plan process. And we do a lot of quoting. And we've written a fair amount of business with OneAmerica on the joint plan basis. When you have a couple, partners, spouses, whatever the case may be, and they're going to apply together, it's going to come out as a joint policy. It's going to be two people insured under one plan. The beauty of it is, first of all, we're able to blend the ages between what the wife or the partner and the husband or the partner wind up having as far as ages. So if I've got somebody that's 68 and I've got the spouse that's 62, I'm going to wind up with an age bracket for that plan of probably around 64, 65 years old. That's helpful in the pricing, first of all. Second of all, when you do a joint plan, you again are blending male and female, the gender issue. If any of you have done anything in long-term care over the course of the last 5 years, you've recognized that from a pricing perspective, that females will pay about 40% more premium for long-term care than males will. And that's not discrimination. That's just simply the insurance companies understanding now finally what their true risks are. First of all, more women buy long-term care than men do. Second of all, more women go on claim than men do. And third, women go on claim and stay on claim a lot longer. Why does that happen? Why are we seeing those types of things today? Well, first of all, women outlive men. It's a known factor that they may outlive us anywhere from 6 to 10 years over what their male counterpart would do. That's the reality that we're seeing today. And the fact that women wind up having, when it comes to long-term care, have more issues that being treated for and being helped for in a long-term care setting than men. Men die off. The reality of it is. So if we could do something to help in that pricing model, certainly that is a true benefit, and that's what's happening here. When it is a joint policy, it's actually regarded as a second to die. What that means is that the life insurance benefit itself will not pay anything to a beneficiary until the second individual under that joint plan has passed away. Upon the death of the first one, the policy is still active. It's still in force because there's still benefits there from the long-term care side for the surviving partner or spouse. When that partner or spouse passes away, and if there's long-term or if there's life insurance benefit that's still there, then that would then be paid out to the heirs of the beneficiary. Inflation protection. It's a rider that helps offset that rising cost of care. We look at it from a couple of different perspectives. Sometimes, depending upon the age and depending upon the benefits that they're looking at purchasing, inflation might not be a good option. It just simply ramps that premium up to the point to where it becomes almost unaffordable. So we look at it from the standpoint that, okay, if a 3% or a 5% inflation option on a plan is going to be too expensive, well, why don't we just increase the monthly benefit for the client? Okay, instead of doing a $5,000 a month benefit, maybe we do a $6,000 or we do a $7,000 or $7,500, and don't put inflation protection on the plan. What we've done is we've built inflation right into that monthly benefit by simply increasing it. That can really help on your pricing, especially when you're talking about people that are 60 or older. And unfortunately, that's where this product really, really comes into play, is for that over 60 market. So just kind of keep that in mind. It may be that the alternate quote that we send out may be one with a little bit higher monthly benefit and no inflation on it at all. Well, that's an attempt to get that price back down there to where it's, first of all, it's affordable, and probably more important, it's viable by the client. Continuing to show people $10,000, $12,000, $15,000 year premiums with this kind of a product, you aren't going to win many of those. I can just tell you that right off the bat. They're in sticker shock, and they're going to say, you know what? I'm just going to sit on the sideline and I'm going to take my chances. And we don't want them to do that. We want to put something in their hands that's going to make some sense. Because I've been an advocate of this for years. A little bit of something is still better than a whole lot of nothing. And if they're sitting on the sideline and they're not doing anything to protect themselves, their family, and their assets, then guess what? They've done nothing, and that's not a good thing for them. It's not a good thing for their family. Long-term care payments are available using a 2%, 3%, or 4% of the death benefit on a monthly basis. So now we're getting into how is the plan designed. Okay, if I look at a $200,000 death benefit for the plan, and I use a 2% factor, that means that client's going to get $4,000 a month of benefits based on a $200,000 life insurance amount. If I'm doing a 3%, it's just simply 3% of that $200,000, or it's $6,000 a month, and the 4% would be $8,000 a month. So you can kind of play with and adjust that to kind of meet what your needs are. What we're seeing typically today from a 70 to a 75% risk factor is around that $5,000 to $6,000 a month. So I may adjust my overall death benefit to accommodate and get to that $5,000 or that $6,000 a month. That's what's going to make that difference. The 2%, 3%, and 4%. Those are etched in stone. There aren't any others, and those don't fluctuate. Those are the same. What will change and what can fluctuate is the amount of death benefit, which is going to dictate what is going to be the monthly benefit that the client's going to receive. Continuation of benefit rider. This is a great way to make this plan work. So I get a quote request in, and they want 5 years of coverage, and they want $6,000 a month, and because of the age of the client, it put the premium at $10,000, $12,000. It's not affordable. So what I'll do instead is that I can do a base plan with this of the 2% category, but I could do a base plan where, and I'm losing my train of thought here, as you could listen to me stumble just here a little bit. Instead of doing a 5-year benefit, I'll do a 2-year benefit on the base. And then on the continuation of benefit rider, I'll do a 33-month on that. So what I wind up with 24 months on the first base plan, and then 33 months on the second plan. And what happens is I wind up with just about 5 years of coverage. The difference is that if I had built it all on the base plan at 5 years, that really ramps that premium up. Whereas if I can build it with a base of just 2 years and the continuation of benefit rider for another 33 months, I'm getting almost 5 years of coverage and really saving somewhere between 20 and 30% of the premium by designing and developing it that way. So some good tools that we're able to utilize. And the other thing about that continuation of benefit rider, for the client that is just adamant, and there are a few of them that are out there, and for the most part, they're not understanding what their real risk in long-term care is, but they had Aunt Ethel that spent 15 years in a nursing home. And a 2-year or a 3-year or a 5-year benefit that we're talking to them about, just in their mind, is not adequate. So with the continuation of benefit rider, you have the ability to design this to be a 5, a 6, or a 7-year total in coverage, or you can do the continuation benefit rider, which is a lifetime benefit. You can add it in there. It'll be expensive, but you know what? It's great because these rates are guaranteed to your client. These rates are guaranteed. They're never going to go up because it's built on a life insurance chassis, not built on a long-term care chassis. That's the difference right there. So you have the ability and the capability of designing the plan into a lifetime benefit if that's what it is, if that's what that client wants. Now, I can build a lifetime plan, and I can make it affordable for the client. It may not be all of the benefit on a monthly basis that they want, but I can build something that'll make some sense and still be affordable. And that's really what we're after. We're after making, first of all, a plan that's, that they're going to be interested in. Number one. Number two, it's affordable. Number three, they buy it. That's the ultimate goal here, is to get them to buy what we're selling because it makes sense for them. So typical portfolio of assets, aggressive assets positioned for significant growth with the exception of risk, of the loss of principal. No different than what it is for any other kind of life insurance or investment type of strategy that you may use. Moderate assets are positioned for some growth with exceptions of some downside risk. It gets smaller, as you can see. And conservative, oftentimes the client wants guarantees, is what it boils down to. Well, with the OneAmerica product, you can do this. You can be aggressive. You can put it together as a moderate process, or you can have it be extremely conservative. And when I say extremely conservative, when you talk about often with guarantees and very little risk, it might be an extended benefit period based on the design, or it may be a lifetime benefit, again, based on the design. You can take that $125,000, multiply it out to a $250,000 benefit, or you could make it a lifetime long-term care plan. It's really up to you. It's just understanding where does the client fit in the overall, portfolio of their assets, and what are their risk factors? What do they typically do? And that requires a conversation. I know you all do a fact finder of some kind. You may call it something different, but the reality of it is that you need to find out what the risk is. Number two, you got to figure out what's the risk factor with the client. What are they comfortable with? Okay, and then and this is probably the hardest thing for agents to understand, and that is getting a premium commitment from the client. If I can build something to design something that makes sense and is affordable, what would be the amount of premium that you would say you could afford on a monthly basis, or something to that degree? It's getting them to understand that this is going to cost something. what are you going to be comfortable with? And that's what I wanted to be thinking in terms of. So when you're doing, your fact finder and you're doing your analysis with the client, see if you can get that built into that overall scheme so that they understand, and it makes it easy for you to come back and say, well, don't you recall we had this conversation? You said $250 a month is affordable, and that probably would be something that you could go with. We came in at 230, but yet you're telling me no. I need to understand what happened here, or variation of that. Okay, cash value, death benefit. These are all unique to this product in comparison to traditional long-term care, which will have no cash value, which will have no death benefit unless you've bought what's known as the return of premium rider, which is nothing more than all of your premium refunded back to you minus any claim that you paid under a traditional long-term care product. That rider can cost anywhere from 40 to 60% more depending upon the age of the client. And they're rolling the dice, because if they have a long-term care claim before they pass away, any benefit paid out from that traditional long-term care policy, that benefit dollar amount is going to get subtracted from any return of premium and could make that whole thing null and void. And you would have wound up paying a whole lot more money for something that you're really not going to get anything back if, in fact, you have a long-term care claim. So, with the asset care concept, and some of you may be familiar with OneAmerica, and up until just this past summer, they had Asset Care 1, Asset Care 2, Asset Care 3, and Asset Care 4. They had 4 different models. One dealt with just straight asset care or straight combo hybrid type of product. Asset Care 2 dealt with limited type of pay plans. Then you got down to Asset Care 3 and 4. These got into a single premium type of models. Now, because of all life insurance companies have to adopt the new CSO tables, which changed the life insurance world. In most cases, it increased premium as a result of what these new mortality tables are telling them. These are based on the 2017 mortality tables that were adopted by the National Association of Insurance Commissioners. So Asset Care now is the name of the product. There is no longer 1, 2, 3, or 4. What they did with the product is that they allow with Asset Care that you can do regular what's known as a lifetime pay. You just pay the same premium until the day that you either go on claim or the day that you die. The next option that you have is to do a limited pay plan. And limited pays are nice because it gets the product paid up in a recognized span of time to where maybe the client's still working and can afford an elevated premium in order to get this thing paid up so that they don't have premiums after they retire. So you can do a 5, a 10, or a 20 limited pay plan. So the premiums are going to be elevated as a result of it. The shorter the span or duration of premium payment, the higher that premium is going to be. So a 5-year payment plan, or the 5-year option as it's called, is going to have the most expensive when it comes to the limited pay plans. So a 5, a 10, or a 20-year on the limited pays. Or you can do a single pay. This would be in the case where the person had maybe some money sitting in CDs and wanted to really utilize that money a whole lot better than just earning 2% per annum on the thing. You could move that money into this type of a program under a single pay, and it's just paid up from day one. Or it might be a situation where the individual has an existing life insurance policy, has cash value in there, and it really just isn't doing a whole lot of good for them anymore. They've had it for 20 years or longer, and they've got sizable cash value that's built up into it. You can move that cash value under a 1035 exchange into this product, and it would work exceptionally well. The drawback to it is is that you can't move money from separate life insurance policies into a joint plan. In other words, you can't have a life insurance policy on her and a life insurance policy on him and be able to move that money into a single joint policy. Can't do that. They would have to have separate plans altogether. So we, and we do this a lot, we recommend, first of all, find out what the cost basis is on that life insurance policy that they currently have. If their intent is to move that money out of that life insurance policy, have that policy go away, and use the cash value to fund this over here, then looking at what the cost basis of that life insurance is, it may be a situation where the cost basis, it's neutral. Makes some sense to cash the policy in, move that money over. They can dump that money into into the plan at that time. If they use it that way and they cash the policies in, utilizing that cash value, then you can move the money from both of those policies because they're taking receipt of it, because the cost basis is in their favor, and then move that money over in under a premium deposit at that point. Now, that money can either be utilized as a single premium, if it's enough to fund what you're wanting to do as far as benefits, or it may be it's a single deposit into the policy to help draw down what that annual premium would be. So we've got a lot of options that are available to us to make this thing work and make it work well all the way around. Minimum issue age on this is age 35. Maximum is age 80. Again, these can be done as single or joint plans. And joint, that definition changed with the new tables that came out this past summer. It used to be that a joint plan could actually be business partners. It could be mother-daughter. It could be two aunts that live together. Not anymore. The joint plans are simply based on husband and wife or partners as defined by particular state law. That's what joint plans invoke today. So funding, again, we've talked about these: cash, CDs, 1035 life exchange. This is still up here, and it shouldn't be. Non-qualified annuities. Annuities under this plan are not available to Western Southern because, as I understand it, you all have your own annuities that are actually manufactured by Western and Southern. So, but a 5, 10, or a 20 pay plans, you got a whole life pay, you got cash value and a death benefit, inflation options. All of those are available. Some of the benefits within inside the plan itself are preset by design, such as the 2, 3, and 4% access for a specific period of time and access against what the life insurance amount would be. So 2% of whatever the life insurance benefit is, that 2% is going to pay it out for 50 months. 3% is going to pay it out for 33 months, and 4% for the 25 months. Inflation options, they're one of two. It's either 3% or it's 5%. Rider policies, again, these kind of mirror what the base policies are. Again, 35 to 80, 5, 10, and 20 pay plans, annual pay, single pays, non-cancelable premiums. They're all set to that way. Inflation options, additional to 50, 33, or 25 months. It just simply matches the base. So if I'm doing a 50 month on the base, I can add another 50 months on the rider, or I can add a lifetime on the rider. If I did that, I probably want to go down and look at that 2%. It makes a little bit more sense. But again, depending upon how many dollars you want delivered on a monthly basis, that's going to kind of dictate how your design is going to be in working this thing up. So single premium whole life with accelerated death benefit for qualifying long-term care expenses. A lot of times, and again, you need to understand the difference between this type of a product and a rider on a life insurance policy. The riders on a life insurance policy, they're all over the board. Some of them are long-term care riders. Some of them are critical illness riders. Some of them are chronic illness riders. Some of them are terminal illness riders, understanding what all of those mean. This is not a rider. This is built-in benefits right from day one. Again, available from issue ages 30 to 80. And typical funding is through money currently in CDs, money market, savings, or life insurance cash value for people that are wanting ways in which to pay for this without increasing their monthly or their annual costs of insurance by just simply reallocating some of these dollars into this type of a program. So if you looked at it, and again, this is just more illustrations so that you get a little bit better understanding of how this thing works. $7,500 per person, 33 months, it'd be $125,000 per person, or a total of $250,000, of the plan itself. When you look at it from the standpoint of accessing, and this is a good example of what we're talking about here. The overall value of the policy is $250,000. That's the death benefit. And what they can do is they can access that benefit at $7,500 a month per person to a maximum of 33 months. That's not a maximum of 33 months per person. That's a maximum of 33 months for the plan at $7,500 a month. So you just need to kind of keep that in mind, that when you have a joint plan, yeah, sure, they both can have a benefit equaling $7,500 a month, but the maximum or overall benefit to be paid out from a duration standpoint is 33 months. So it might be one person going the full 33 months, or it might be both of them going 16 and a half months to equal that 33 months. So just kind of keep that in mind. The continuation of benefit riders, again, you can do this at equal to what that base was as far as the duration of months. So you could add another 250,000. That just simply gives it a longer period of duration in which the benefits can be paid. Or you can do a lifetime rider put on it on the continuation of benefit. And this literally takes it from a specified duration of time to an unlimited benefit. And it's surprising when you look at it, again, if you don't have inflation on it, it's surprising at the pricing of it. If you looked at a traditional long-term care policy today, and you looked at it from the standpoint of pricing, a 5-year benefit is about the maximum that you can get today in a traditional long-term care policy. A 5-year benefit for somebody that's in their 60s is probably going to be $6,000 to $8,000 a year. And when you look at it here with a lifetime benefit, and again, without inflation protection on there, the premium is not that much higher. It really isn't. And you're getting a lifetime of benefits. It really doesn't ramp that premium up nearly as much as you would think it would do. But again, inflation, that's the thing that drives a lot of these plans as to whether or not they're affordable or they're going to work for your client. So again, this is more of the same thing that we just talked about. 25 months, 33 months, 50 months, those are locked into the policy. You can't deviate from them. And each one, the 25 months, you then have a 4% of whatever the death benefit is, it's going to pay that for 25 months. If you want to have a 3% of the death benefit, it's just going to extend it out a little bit further to 33 months. And 2%, it'll do it for 50 months. It may be at 2% that you need to increase the life insurance amount in order to make it work and to fit what the client's needs are. So the continuation of benefit rider, protects against the cost of that extended qualifying care. And when we talk about qualifying care, how does this product work, and is it different than traditional long-term care when it comes to getting access to benefits and what are considered qualified benefits or qualified care? The reality of it is today that in order to receive benefits under the plan, the care has to be provided by a recognized, licensed, or certified care provider in the state in which the client lives in. And what in essence that means is the care has to come from a institution, whether it be a nursing home, an assisted living facility, or a home health care agency. You're not able to, and it's not just this, it's all long-term care now, you're not able to hire the neighbor lady who's a retired nurse, or the neighbor lady who is a retired school teacher, that is going to come over and sit with mom or dad during the daytime. You can't do that. This has to come from a home care agency, and that's the checks and balances. As you can well imagine, if you're paying a family member, there's no guarantee that that family member actually has performed the services that are required, and that's the safety. That's kind of the safety net for the insurance company. The COB, as it's called, the COB rider, can be added to any asset care based policy with an additional premium at the time of application. All of these benefits are designed around making the decision at the time of application. To add these later, it may not be available, number one, or it may be available at an additional cost, and it may be available only if you can medically qualify. In other words, you got to go back through underwriting again. Now, from an underwriting perspective, how is this product compared to traditional long-term care? And the answer to that is there really isn't any difference. The big thing here with an asset care type of product, a hybrid combo, whatever you want to call it, they have to take into account not only the morbidity of the client that deals with the disabilities that they can have and needing care and assistance, they also have to deal with the mortality of the client. So you've got morbidity and mortality going on at the same time. Now, because of that, there are some health conditions that they're a little bit more inclined to take than a traditional long-term care model company would do. But things like heart failure or heart disease, diabetes that's not controlled, or the A1C level is elevated beyond 7. Those are going to be the same no matter what. Things like multiple sclerosis, current treatment of cancer. Again, those are going to be handled from an underwriting perspective basically the same way that traditional long-term care is. Where we get the added benefit is in some areas of heart disease, as a matter of fact. People who have multiple medications for high blood pressure or cholesterol. Those are still insurable conditions with this type of a product where they may be questionable or may not be available with traditional long-term care. So just kind of keep that in mind. Sometimes people think that because this is combining life and long-term care that somehow the underwriting is going to be easier. That's not the case. The risk factors for long-term care are the same with this product as they are with traditional long-term care. Incident of claim, same risk factors. So again, kind of keep that in mind. The COB rider may not be available in all states. I believe in the states that you all sell in, it is universal now, so it shouldn't be an issue with being able to put that rider on there. And again, this is just recapturing some of the same things that we just talked about the 2, 3, 4%, the payment plans of 5, 10, 20 pay and ongoing premiums and that sort of thing. So it is a whole life insurance policy with an accelerated death benefit for qualifying long-term care expenses. And again, I outlined what that qualifying expense would be. Available issue ages, this is incorrect. It is 30 to 80 now. That was changed with the adoption of this of the new CSO tables. Premiums can be paid on a 5, 10, or a 20-year basis for a limited plan. Our premium payments can be paid annually through modal options as monthly, quarterly, semi-annually, or annually. And this also has changed with the new model. It becomes a paid-up policy at age 95. No more premiums after age 95. So what's the market? Where do you kind of look for clients in prospecting? Well, OneAmerica would certainly like you to think that the clientele is typically younger than their single pay clients, ages 40 to 70. We see it from the perspective of, what are the ages that we typically are quoting? And that really is between 60 and 70. That seems to be where the product has kind of fit the mold. And that's where we do the most quoting, is 60 to 70. And the reason for that is that that's kind of the age group where people are starting to take a real hard look at what it's going to look like in retirement years going forward. And what have they done to mitigate as much risk as they possibly can, and certainly long-term care is one of those risks that they're concerned about. Prefer asset-based over traditional long-term care, but without a single premium to be used. So again, for people that have issues with traditional long-term care, the use it or lose it type of proposition, yeah, this makes a lot of sense, and they don't have to utilize it as a single premium. Many of the hybrid type of products that are out there require that the premium be a single premium. The product is designed around rolling money over, doing 1035s, taking money out of CDs or money markets or whatever. That's the design of what their products look like. OneAmerica really captured the market by making this available, first of all, as a single pay. They can match the competitors on that. Doing limited pays of 5, 10, and 20 years. And then just doing ongoing premium payments makes a huge difference when you look at the overall access to this type of a plan. Pension retirees or still employed with earned income. Again, goes back to what I said earlier. We see an awful lot of people in their their late 50s into their early 60s that are looking at figuring out a way to handle the risk and recognizing and understanding that, hey, this is a big issue. I don't want to have to use my own assets if I don't have to. The risk is too great, so they're looking for a way to mitigate that by, capitalizing on a product that's available that's going to eliminate, that risk factor for them, or at least it slows it down somewhat, and they're not paying 100% for that care. Income rich, asset poor, dollar cost averaging, into asset care. However you're approaching those clients in your overall scheme and how you place the product, number one, but how are you developing your fact find with the client and understanding that they have a risk, illustrating what that risk is, and then show them a way to really mitigate the risk and basically shuffle that risk off of their shoulders and on the shoulders of someone else. Okay. Again, annuities not available. Real issue with long-term care today has always been the issue about rate increases after they buy the plan. Nobody's immune to it. There isn't a single plan out there, isn't a single company out there that's ever sold long-term care that hasn't taken rate increases on their plans with their existing clients. That's a huge issue. And of course, that's what people are hearing. I mean, that's what consumers hear. They hear about the 40, the 50, the 80, the 100% rate increases that some of these companies have, placed on top of their plans. And then, the client's got to make a decision. Do I continue pouring more money into this, or do I, cut my losses and end the plan now? Well, with an asset-based long-term care combo hybrid product, they never had that worry because it's built on a life insurance chassis. Means that they're never going to have a rate increase. It's locked in. Those premiums are guaranteed for life. As a matter of fact, on the very first page of the policy, it states that. So there's a great deal of comfort as a result of that when you're looking at an asset-based type of product. Okay. Again, these are just some examples. I'm not going to go through these. This is an old one on the asset care. So here are the marketing materials that are available to you. Helping guarantee your family's financial security. These are available actually on the microsite. For those of you that are familiar with the microsite, it is a website that Financial Brokerage developed specifically for Western and Southern agents. On that site, if you click on products and then you click on the hybrid product with OneAmerica, you'll see these brochures. You'll see these things that are available to help you state the case of why OneAmerica and why a hybrid product might work best for handling those issues with your clients. So again, it's intended to, or the design around their marketing material is more family-based. And I think that's a real key factor when you're looking at it here. It's not just about the mom and the dad or the grandparents. It's about the whole family, because in long-term care, the whole family is connected as a result of it. And I've told OneAmerica this on a couple of occasions, somewhat with tongue in cheek. And I told him, I says, thank God that your marketing department didn't put some 65-year-old person on a bicycle. For some reason, these insurance companies think that that's what people that are 65 and older do. They just ride bicycles all the time. And it just made no sense to me at all. So theirs is really focused on the family. It's designed around that so that the whole family can hopefully be involved in it. Because when a long-term care crisis and a long-term care event occurs, it's not just about the one that's afflicted with it or their partner or their spouse. It's their whole family. It's their kids. It's their grandkids. They're all affected by it. And so a lot of their product material is centered and focused around that. So I know that there's a lot of information that I covered today. Hopefully this gives you a little bit of an insight into how this product works, where it might be appropriate, and how you go about, building a plan that's going to make some sense. Keep in mind that, if the quote that you get back based upon the information that you provided is out in left field someplace as far as its price, don't give up on it and disregard it altogether. If we haven't sent an alternate quote that gives you another alternative, gives you another idea, then pick up the phone and call us and make sure that we understand, what you're looking at and how we might be able to design something with a little bit better pricing. It may not be all the benefits in the world, but again, that old adage, a little bit of something's better than a whole lot of nothing. We want to make sure that we're making that point to our clients as well. Now, before I open the phone lines up, I have one last disclaimer that you all need to pay attention to. The OneAmerica product is a life insurance-based product. As a result of that, with Western Southern, in order for you to sell this product, you have to have prior authorization from Western and Southern corporate in order to do so. And you ask, why? When we've got all of these other products and there's no issue at all. The whole thing behind this is that Western Southern corporate wants to make sure that you've explored every other opportunity with their core life insurance products before you jump into this. I can tell you that for the past, and we've had the product with Western and Southern for a little over a year now, I've not had one time where Western Southern corporate said, no, you can't do it. You need to do this or you need to do that. They just want to make sure that you've explored all of the other opportunities first. The gentleman that you can reach out to, if you have a case and you want to get authorization to be able to sell it, his name is Clayton Morris, Morris, and his sidekick, as I call her, Mary Kinman. Either one of those you can reach out to if you have a case that you've gotten to the point where you've illustrated it, you've sat down with the client, they've just, they like what they're seeing. That's the point then that you want to reach out to Western Southern corporate and make sure that you have that go ahead. And again, we've not had any issues in the past, but you just need to be aware that as it sits right now, that is what the requirements itself are. So with that, I'm going to open up the phones. Hopefully we'll have a few questions and we'll kind of go from there. So, all right, phones are open.
All right, real quick, we got one question for us. Let's see. Will a person have to go through the 8-hour long-term training to be able to sell this product?
And the answer to that is yes, because it is a long-term care. It's a tax-qualified product, which simply means that the benefits paid at the time of claim are going to come out tax-free. So it does require that the partnership certification be in place in order to sell the product.
Thank you. Any other questions?
Leonard, I got 2 questions for you. So one on minimum issue age, I just want to clarify, is it 30 or 35?
Ask that again.
The minimum issue age, what was that again?
It's 30. Yeah, age is 30 to 80.
And then secondly, we're talking about security or risk classification. Do you also have to register to be able to sell the product or no?
No, you do not.
So with this being a qualified plan, would it qualify for various states who have the matching benefit of what they'll allow you to keep in the state? You have so much long-term care benefit.
I'm getting a lot of feedback. I'll try to answer what I think you're asking. This product has the capability of accepting both non-qualified and qualified money. You can't commingle them. Okay, so if you have qualified money that's coming over from an existing, say, an IRA or a 401k, which you're allowed to move that money, you can do so, and you can place it into this product. And basically what you've done is you've taken a taxable asset, which, you know, when you take money out of an IRA or a 401k, it's going to be taxable. You've taken a taxable event and turned it into a non-taxable event. That's a real advantage when you're looking at this kind of a product. But you can only move qualified money into the product or non-qualified money into the product. You can't commingle the two of them together into the product.
Okay, thank you. That makes sense.
Okay.
So the question I was asking Leonard, is more about the states have different regulations. Different states are different, but they will give you some additional asset protection in qualifying for Medicaid if you have qualified long-term care benefit up to certain amounts.
Mm-hmm.
Would this count towards that?
Yeah, you want to know if this product qualifies under what's known as the partnership program, and the answer to that is no, it does not.
Okay.
Even though it, yeah, that's the strange thing about it. Even though it doesn't give you the asset protection in regards to Medicaid spend down, they still require that you have that partnership certification in order to sell it. Doesn't make a lot of sense to me.
Right.
But those are the rules.
Right.
So, yeah.
Absolutely.
Okay.
Anything
All right.
else? No, I think we're good on our end, Leonard.
Okay. Again, I would just, I would recommend that each one that was on the call today, if you've got concerns, you got a question about a quote, pick up the phone, call us. Utilize the microsite for requesting quotes, reading the material, understanding how the process works with this product. So, with that, I'm going to bid you farewell. I wish you good selling for the rest of the week, and until we do this again, have a good one.
All right, thanks again, Leonard. Appreciate it.
All right. So give me some interesting scenarios that will play into. Jerry, we got one. We were kind of talking this morning what to do with the case tonight. Jack, you had a case